understand regulation, you have to understand that maintaining trust and confidence in the financial system is key. Today, the system is more interconnected than ever before. A crisis of confidence in one banking system in one country can spread across the globe, making banking regulation more important than ever.
It's all about managing that risk of failure and managing the risk of there being a global financial crisis.
The primary role of regulation traditionally has been around the prudential soundness of banks. So in other words, making sure that they don't go bust. Therefore, people can have confidence that their money is safe if it's invested with the bank. And similarly, if you're relying on the bank as a source of funding, that source of funding is going to be there long term. More recently, there's been far more emphasis then on the conduct of banks, how they go about treating their customers in their day-to-day activities. How do they deal with supporting society's goals in a number of areas, for example, anti-money laundering or dealing with terrorist financing as well? So really those two things now, when you look around the world, are generally the principal objectives of regulation.
It must be remembered that a regulator like the FCA or the PRA is regulating tens of thousands of firms. It cannot supervise them all directly, but the whole system is very dependent on people following those rules and enforcement being used as an example to others rather than, an actual tool of ensuring compliance.
So banks haven't always been regulated. In the UK, there was a lot of self-regulation, which obviously went as well as you can imagine. The first piece of legislation that was passed to regulate banks occurred in 1979, so it's as recent as that. In the US, it's been a bit longer than that. They first introduced the idea of deposit insurance in the 1930s. But really, in terms of the global banking situation and regulation, it's only really been in place since the late 1980s.
At a global level, people look to the UK, they look to the US, they now look to Hong Kong/China and Japan. But, a few big players set the tone for the globe, I would say.
Who defines regulation at a global scale, and how is it implemented at a national level?
So if we think about the global regulators, they are generally standard setters only, and there's two main ones that we really talk about. The first is the Basel Committee on Banking Supervision, which sets all of the standards around financial stability and safety and soundness. And secondly, there's IOSCO, which is the International Organisation of Securities Commissioners, and they set the standards around all the securities markets in the world. Now, they set those standards, but those standards are not law. Those global standards will need to be written into the legislation of the country, but that means that there's room for some interpretation and difference. So the ideal is a global harmonisation and that there's no difference at all. That rarely happens in reality.
So there are three broad models that we can see for regulation around the world. In some cases, you have a unified regulator, so usually the central bank is doing everything. Probably the best example of that is the Monetary Authority in Singapore, who fulfills all of those kinds of functions. You then have what's described as a Twin Peaks model, where central banking and prudential concerns are dealt with usually by central bank or a prudential regulator. And then conduct is largely dealt with by a separate specialist conduct regulator. Examples of that would be the UK and Australia with the FCA and the PRA and APRA and ASIC in Australia. Or you have functional regulators. So in some parts of the world, regulation is split between the kind of product that we're talking about, whether it's banking, insurance. China's probably one of the best known.
In the same way that countries vary their models of regulation, they also use slightly different methodologies too. Some, like the US, use rules-based regulation, a set of rules you must follow to the letter of the law. Others, like the UK, use principles-based regulation, where the rulebook of written rules, which, when printed out, is 6'2" in height, is instead underpinned by a set of 11 guiding principles, which focus on the outcomes, either for customers or for financial stability. But they don't tell the banks exactly what steps to take to get there.
The reasons regulators are moving in this direction and like it is, one, it's impossible to legislate for every situation. So you do need an overriding spirit of the law on top of that people need to follow. In the UK, the recent PPI scandal was all based on failure to follow the principles, not so much failure to follow specific bits of law. For a bank, there's uncertainty over the precise standard the regulator wants, but also much more flexibility on how you meet that standard.
There is an argument that principles-based or outcomes-focused regulation does leave more room for innovation. I think what it lacks is any incentive. So you can potentially achieve the same outcome using email and spreadsheets as you could with the latest AI technology.
Whichever method a regulator uses, there is always a line of communication between them and the banks to ensure banks have adequate capital. They are looking after their customers and fighting fraud and money laundering, but also to discuss how the system runs overall. Enforcement is generally the last resort for regulators, but there are times when it is necessary to avoid crises or customer harm.
We can never really think about the role of the regulator separately to politics and what's happening geopolitically. Back in the early 2000s, in the world of third way Labour in the UK, there was all this talk of light touch regulation. Markets know best, and the regulator should just operate at arm's length from the markets. If you look at kind of the post-mortems of the global financial crisis, fingers were pointed at that light touch regulation, at holes in the rules. That all changed following the global financial crisis, and the role of the regulator became tougher. I think the pendulum swung the other way again now with regulators, and a lot of that is to do with this technological innovation. I think this is where principles-based regulation really comes into its own, because it's flexible enough to allow for that innovation because it's not prescribing the how of compliance. I think when we're talking about things like AI and cloud, I think regulators are still playing catch up a little bit, but I think the speed of technological innovation means that they're having to put processes and structures in place that allows them to keep up, even if the rules aren't necessarily changing.
Technological developments and innovation, by definition, will run ahead of regulation. The issues for regulators are, firstly, how far do they lean forward into that? What techniques can they use to try and understand? So, for example, the use of sandboxes, they can be used not only to help firms into the market, but they're really valuable for regulators to understand what's actually going on in the underlying technology. And then finally, there's a question of how far does the regulator become, to some degree, a leader of innovation? So whether it's the sort of tech sprints that have been run in the UK, the big experiments the Bank of England's now running around central bank digital currencies, for example.
Looking to the future, as regulators try to keep up with the pace of innovation and technology and the interconnectedness of global banking systems, will we ever see a single global regulator?
I think we will never, ever see a single global financial regulator. And I think that's for many of the reasons I've already talked about. National interest, global competition to be a financial centre, politics, different cultural factors. So many issues would stand in the way of that kind of harmonisation.
A single world view of how to regulate banks is probably quite a long way off. I think this is something that's going to be jealously guarded by national parliaments and national governments for many years to come.
And I don't think it's desirable either. So if everyone is doing exactly the same thing, one thing fails, it's going to fail globally and it will be a catastrophe.
If there is no global regulator on the horizon, will regulation still be the same in 50 to 100 years' time?
It will be completely different, but done in the same way, as in a set of rules, limited supervision of the bigger players, and selective enforcement action to encourage the other to set an example. I don't see that changing. I think probably the interesting question will be is whether financial services is so tied up in other things that it's still regulated on a standalone basis or has been combined with other regulators or other types of services.
It's very hard to know what regulation will look like in 50 to 100 years without thinking about potentially what the banking system will look like. And the way things are going, it looks as if a lot of financial services and banking is going to become more and more disintermediated, which means that there's no longer a systemic risk in terms of the banks, but we'll all potentially bear a little bit more of that risk. So I think we'll start to see a lot more emphasis on individual consumer protection, perhaps. I think it'll become harder for regulators to stay technology neutral. I think a lot of regulation will be done by technology. I think there'll be no more spreadsheets, but I like to think there'll be no more spreadsheets in 50 to 100 years. I think the how of regulation will probably change, and the what will change depending on how the banking system itself evolves.